The government wants fewer investors competing for existing homes. It wants first home buyers to have a better chance. It wants to encourage existing investors to sell, and it wants more capital flowing into new housing supply. That's the intention behind the budget property changes. But is it going to play out the way the government wants it to? Because the property market doesn't move in line with policy announcements. It moves based on the decisions made at the dinner tables of millions of households. Those decisions will play out very differently, table by table. Whether you are younger, older, with a lot or not a lot of family wealth, whether you're renting or a homeowner or a first home buyer, whether you have a quality investment property or a poor one. So today I want to go through how changes in incentives change behaviour. Who are the winners? Who are the losers? And how will the property market respond in ways you might not expect? And if you want to fully understand the context behind the shifts in the market due to the federal budget, please make sure you watch part 1 of this series. The place to start is the single biggest mistake people make with this policy: turning a national tax change into a national property forecast. Property will go down 10%, Sydney property will go down 20%. Importantly, we don't buy the Australian property market. We don't even buy Sydney. We own one or some of the 11.5 million dwellings. What happens to each of those dwellings depends entirely on that dwelling. How will the budget change the next buyer of that property? Let me explain. A 3-bedroom house in a tightly held owner-occupier suburb is completely different from a 1-bed high-density apartment. An investor owning a house in Brisbane is a different proposition to one who's owned an apartment in Melbourne for years. A homeowner in Perth, Brisbane, Adelaide is feeling different from those in Sydney, Melbourne and Canberra right now. Because what truly matters is how much this budget affects investor demand. And in fairness, also encourages owner-occupiers. ABS show investment loans reached a record high in the September quarter of 2025, a record 40% of new loans. This has been growing every year since 2021. To put that in numbers, around 200,000 investment properties have been bought each year. And while 20% of that has been invested to create new homes, 80% of those investors bought established properties, either from other investors or households wanting to upgrade or downsize. So it's clear that investors are not solving Australia's challenge of building more homes. They are competing for existing homes. And the reality of it is that they are buying exactly where first home buyers can afford. In particular, over the last 5 years, they've been buying outer houses in Brisbane, Adelaide, Perth, regional houses all over the country where yields were higher, established apartments and townhouses near the city. So the question you should be asking yourself isn't what happens to property, but if the investment market changes completely, are investors a likely buyer for my property? Will other investors want to sell? Do investors currently mostly own what I want to buy? Or do I own a property that very few investors own? Do I want to buy a property that investors haven't been buying recently? One thing I'll be watching closely over the coming months is what happens to the parts of the cities and towns that attracted the most investor activity in the last 5 years. There was a proliferation of new-to-industry buyers agents all singing the same song. Brisbane, Perth and Adelaide have had enormous runs. Perth is up over 90%, Brisbane 80% and Adelaide 75%. Part of that was driven by fundamentals like population growth. Catching up from years of little growth in the 2010s, it was more affordable than Sydney and Melbourne. It had strong rental markets, better yields and tight listings. But what was driving investors was the pursuit of short-term rewards. Tight borrowing capacities, higher rates and the same buying story. So many investors with the same information bought the same type of property at the same time. Many of these investors were living in Sydney and Melbourne, rent vesting instead of buying their first home. Many investors were looking for markets to make a quick return, and many who wanted to upgrade their home invested instead. So when the budget removes the incentive for future investors to buy where they bought, they are forcing markets to be repriced based on owner-occupiers in that market. The question is, if those markets have had their big run, if the growth prospects are looking much smaller, if the market fundamentals are showing rising listings and longer days on market, and the tax changes make future investing in established property less attractive, do many of those investors decide it is time to take money off the table while they can? Do investors decide to sell knowing from 1 July 2027 capital gains tax will be at a much higher rate? Do Sydney and Melbourne investors cash in and use their borrowing capacity to upgrade into a tax-free home? Do Brisbane, Perth and Adelaide locals decide to take gains, reduce debt or put money into super? So while many people focus on the immediate reduction in buyer demand, and yes, it's clear that much fewer investors will be entering, the bigger impact may be on existing investors who've already had a huge run, asking themselves whether it's better to hold or sell. The questions I would be asking about my property are, is the owner-occupier pool strong at current prices? Can the locals comfortably afford the current prices? Or is affordability stretched at current mortgage rates? Could I continue to hold the property and my home at higher interest rate? Is it still worth the risk to hold this property? Is the growth worth it? Should we put that money somewhere else? That's a very different dynamic from the assumption that investors will hold because of grandfathered negative gearing. That's the true story we must discuss. Now, to be clear, houses and apartments will respond differently across regions and cities. The gap between the two matters more than most understand. Established houses are typically driven by owner-occupier demand. Often 70 to 90% of houses in a suburb could be owned by homeowners, not investors. Families want land, they need the bedrooms, they want long-term security. In most suburbs, there are only so many houses that can exist. And in fact, only so many that they can ever buy. For a high-quality family house in a desirable owner-occupier suburb, the budget may not weaken demand at all. In fact, investors may have not been able to afford them for years. They are entirely driven by owner-occupiers. But the irony here is that the pre-budget world, some investors may have sold each year. But in a post-budget world, do they actually hold tighter? They may think, I own something that's becoming more scarce. I cannot buy another investment property. There will never be more houses for rent. And if owner-occupiers still want to live here, why would I sell? For existing investors who own genuinely owner-occupier driven properties, if they believe in the future of their property, if they can afford to hold the negative cash flow or they're positive, a higher capital gains tax that is due only when they sell may actually mean they decide to try to almost never sell, freezing up a huge part of potential future homes for families to buy while securing a rental pool for renters. Apartments, however, are bound to be more mixed. There are two types generally. Some are much older. They're established apartments in inner ring and middle ring locations. They have larger floor plans. They're private, safe, and they're loved. They're small blocks on quiet streets. They're surrounded by other houses and nature. These apartments appeal to families, couples, singles, and cashed-up downsizers. They're almost like a house and are often owned by homeowners. They offer a similar lifestyle at the fraction of the cost of buying a house. But there are also other apartments. They've been built en masse for the last 20 to 30 years. They are almost entirely bought by investors. They are more densely populated in busier locations. They have high strata costs and much smaller land. They often face constant competition from newly built ones. These apartments are very sensitive to the investment market. They are not only currently owned by investors, but they are often bought by them when they sell. So when people say apartments, they are not all the same thing. A boutique apartment in a tightly held inner suburb is very different from a high-density investor product where the next buyer was always going to be another investor. This is the second category where the budget could have the biggest effect. If the next investor can borrow less, can't offset losses, and face less favourable capital gains tax treatment going forward, do they want to buy it at all? Would they prefer to buy a new apartment with better tax treatment? And if the first home buyer doesn't want to buy it either, the big question is who will buy it? So what this raises is the question of what existing investors do in response. The budget creates a genuine fork in the road for people who already own an investment property. Their next move is going to depend on what kind of property they own, how much debt they're carrying, and where they are in life. On one hand, existing investors are grandfathered for negative gearing if they held the property before budget night. That is valuable for some because future investors buying established property won't have the same ability to offset losses against salary income from the 1st of July 2027. So some investors will hold. They'll say, I already own the assets. I've already paid stamp duty. The costs to hold. And if I sell, I have to find somewhere else to put that money. And for good properties, that logic is sound. But the other side of the decision is capital gains tax. The proposed CGT changes only protect gains accrued up to 1 July 2027. Gains after are subject to the new regime, with indexation and a 30% minimum tax on gains. So an existing investor might ask a different question. Do I keep holding this property for the next 10 years, or am I planning to sell it anyway? Am I better to just sell and avoid paying capital gains tax at a much higher rate on future gains? Rental yields are low, debt is expensive, and the next buyer pool may look much smaller or even stronger. So for some investors, the answer will be to hold. For others, and I believe for many, it will be to sell. The key point we must highlight is that 50% of current investors are aged over 50. And 90% of investors own 1 or 2 properties. So when households can see retirement on the horizon, superannuation becomes a serious alternative for any wealth outside of their home. Superannuation is generally taxed at 15% in the accumulation phase, with a 1/3 CGT discounts for assets held longer than 12 months, so 10%. And once a person is aged over 60, depending on their circumstances, the ATO notes that retirement pension phase assets can be exempt from tax. So for older Australians, especially someone closer to retirement, the tax comparison becomes very real on future gains. On 30 June 2027, they will have to get a valuation on all their assets. That valuation task will force them to ask big questions and make decisions. Do I keep a low-yielding investment property with higher future CGT? Do I move some capital into a lower tax environment with more liquidity and less personal hassle? If super is not a viable option, do we pay off the home loan, renovate the home, help the kids buy a home or even the grandchildren? Perhaps do we sell to enable us to buy a new apartment as our future retirement home? That might be a better property to hold instead. What investors over the age of 50 decide to do in response to this budget is what I believe will be the biggest behavioural shift we must watch over the next few years. For investors looking to continue to invest in established property under the new rules, the equation has changed significantly. It will cause investors to respond in new ways to target a different type of investment property. The cash flow problem is an obvious one. If you buy $1 million established property, borrow 105% of the value using equity from another property, at a 6.5% interest rate, that's around $68,000 a year in interest alone. If the property yields 4%, that's around $40,000 a year in rent. Then you'll have to remove around $10,000 a year in ownership costs. Council rates, insurance, repairs, management. The property is roughly $38,000 a year negative. If the yield is closer to 3%, which is common in a lot of lower yield capital city markets, the rent drops to $30,000 and the negative cash flow widens to nearly $48,000. Under the old rules, many investors accepted the loss because it helped reduce their taxable income and they were betting on capital growth over time. Under the new rules, that loss gets quarantined. It can be used against other property rental income or capital gains, but it can't be used to reduce salary income in the same way anymore. So the investor has to be much more confident in growth. Yet at the same time, they will want a much higher yield, a lower purchase price, and more manageable debt. And this is where we need to be careful, because investors will simply chase higher yield, often cheaper properties. And there's usually a reason it currently has a higher yield. It may be a weaker location. It is likely to have more tenant risk and higher maintenance costs. It will likely have much lower owner-occupier demand, hence why it's high yield. It may be much more exposed if conditions turn. So for some investors who want to buy established property, they won't disappear from the market entirely, but they will move further down in price points, push up the price of properties with higher yields until they're no longer high yield. Cheaper properties in the next affordable regional market. Dual income properties, which may have rental demand, but not owner-occupier. Higher rent apartments that appear manageable to invest in. But ultimately, who wants to buy them in the long term? So while this may work for some investors in the short term, the likely bigger consequence is that the most affordable parts of the market become less affordable. In recent years, there's been an enormous rise in a buyer hotspot strategy. But post-budget, this has become much harder. Indexation doesn't help investors over a short period if they buy and sell quickly. The inflation adjustment to the cost base is minimal. Any gains will be heavily taxed under the new rules. An investor still has to pay stamp duty, buyer's agents, high renovation costs and agents. They may be less confident in shorter term returns. Even if they get it right, they will keep much less of the upside due to CGT. The flipping strategy was always challenged, but in this new world, even less so. However, the big question on everyone's mind is whether investors should buy new instead. And while time will tell, I have my doubts if they will fall for it. Most investors in new builds have had abysmal returns for many years. They've heard the stories of the defects. They have seen their parents wish they'd never bought those apartments. They understand that when they sell it, the next buyer won't be another investors. Investors are way more savvy than in 2016, but the desire to sell them the dream will never have been greater. What I do think is that future investors will look to build. For sophisticated investors, they are likely to be attracted to the tax benefits. Duplexes, townhouses, undertaking land subdivision, and ultimately densifying our missing middle. In time, it might be the most important outcome of this budget, not funding high-density developments or competing with first home buyers in greenfield estates. Building well-built, smaller properties that are highly desirable to families. To be clear, however, this is not possible for every investor. These projects take time, money, skill, finance, planning, builders, and risk tolerance. Most mum and dad investors are not developers. And in the current market, buying land and building does not make sense. What investors do in the coming years remains to be seen. Now, the biggest assumption behind when investors step back is that first home buyers will fill the gap. First home buyers are clearly one of the winners from this policy. But there are a few things that complicate that story. The policy logic is straightforward. If fewer investors are bidding for established home, first home buyers should face less competition. In many cases, investors have been beating first home buyers, securing townhouses, villas, older apartments and houses. Post-budget, investors are less likely to be able to make the numbers work. The first home buyer will have a much better chance. But the first caveat is their lack of borrowing capacity and market confidence. 5% deposit schemes have massively reduced the deposit hurdle, but they don't remove the borrowing challenge, higher rates, living costs and loan repayments. First home buyers may still not be able to afford or want to pay the current market price. The second caveat is what they're actually buying. If investors are selling lower quality, high supply investment properties, that doesn't automatically make it a home they want. First home buyers prefer buying in a suburb with strong owner-occupier demand, better long-term livability, and often somewhere they want to raise a family. So even though it may mean taking their time to find it or compromising differently, the question is, do they want to buy what the investor is selling? The third caveat, which is one of the biggest unintended consequences of this policy, is rent vesting. For many younger Australians, especially in Sydney and Melbourne, rent vesting has been the way to enter the market when you can't afford to buy where you want to live, or you don't actually know where you want to live long term. You rent in a suburb that suits your work and lifestyle, and you buy an investment property instead. It's been a common strategy for younger people to get a foot in the door. But as buying an established investment property becomes much harder, that option has almost entirely been shut down. Because the rental market is under serious pressure, the real risk goes well beyond rents simply going up. The simple argument that as investors leave the market, rental property numbers fall, rental demand also declines, and rents remain unchanged. But the reality is much more complicated than that. If an investor sells a rental property to a first home buyer, yes, the total rental pool falls by one property, and the demand falls by one if the first home buyer was renting. But often it doesn't work like that. Firstly, the first home buyer may be flat sharing or living with family. They might be living in an inner city apartment and buying a suburban house. The uncomfortable truth is that the renting household will be forced to leave, and they may not be able to buy. They may not have the savings, income, or borrowing capacity. They may not be able to find other viable rental options, and they may not be able to easily move suburbs. Schools, childcare, family support, and established networks. At a system level, it appears to be a one-for-one switch of rental supply. But the real issue is transition and displacement. The person who buys the property is often not the one renting it. The investor is selling a house rented by a family that now has to move. First home buyers leave the family home and enter the rental market. Displacement has already been happening for years. At some point, rents can't keep rising. Households must change their behaviour. They will share, leave, move back in with family, or be forced to accept lower quality housing. They will delay forming their own household, have fewer kids, move further out, or they will fall into a new level of housing stress. If more investors sell existing rentals before new supply is actually delivered, the transition period could be very difficult for the people who can afford it the least. How long that transition lasts depends almost entirely on how quickly new housing can actually be built. So after going through all of that, the obvious question is, who actually comes out ahead from this? Who gets caught in the transition? The winners are likely to be selective. Some first home buyers will benefit, especially those buying established homes. The first home buyers who previously had investors pushing them out. Some owner-occupiers in quality suburbs may benefit. Their assets have just become scarcer and more tightly held over time, particularly if households decide to upgrade en masse once the future of interest rates becomes clearer. Some developers may benefit if they can generally deliver new supply that qualifies for better tax treatment. Some existing investors who own great property may also benefit by holding assets that become harder for future investors to acquire under the same conditions. But the losers could be significant too. New investors entering established properties face a much harder equation. Rent investors lose one of the most common pathways into the market. Renters face displacement if investors sell before new supply arrives. Investors who bought in overcooked boom markets may find the next pool of buyers much thinner. First home buyers may be pushed towards properties that investors no longer want without fully understanding the consequences. My view is that the budget probably does change behaviour in the way that it wants. It will make future investing in established property much harder. It will prompt some investors to reassess whether to hold, sell, reduce debt, or redirect capital into super, shares, or new housing. It will help some first home buyers compete in some segments. But I'm much less convinced that it automatically delivers the outcome the government wants. Because if investors sell rental properties, renters may be displaced before new supply exists. If capital is redirected toward new housing, developers still need feasible projects. If investors chase yield rather than quality, we may just push risk into other parts of the market. If first home buyers don't want investor properties, we could see steep price falls. Right now, I'm having these conversations every day. First home buyers are trying to work out whether this genuinely helps them, what they should do in response. Upgraders are wondering whether to move now or sit tight waiting for more certainty. Current investors are running the numbers on whether to hold, sell, or redirect it into something else entirely. New investors are almost entirely out of the market for the time being. Every one of those conversations comes back to the same thing. The market has significantly changed under the new rules. So in the next video, I want to go through each of those situations. Talk about what I'd actually be thinking about if I was a first home buyer, upgrader, or an investor right now. Stay tuned.